Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. The health of the labor market is something Fed tracks closely. If we keep all other indicators constant, a low unemployment rate and higher available jobs encourages the Fed to hike rates, playing into a narrative of a tight labor market. If we look at Fed Watch, which provides the market expected probabilities of rate hikes, probabilities between no hike and a 25 basis have been swinging for the past few weeks. And this is reflected in the movement of the dollar index as it trades in a range between 101.5 and 103. Uh, Morning, JK. How are you reading Friday's NFP and unemployment numbers? It seems it has somewhat bettered Fed's chance of hiking in the next meeting. But what do you think?
Good morning, Swaraj. Back from long weekend. I think, I would say that the non-farm payroll report for once is not really that conclusive. Yes, it came at 236,000 and then unemployment rate did not rise to 3.6, was at 3.5. But if you look at all other indicators towards the in the build up to the NFP, it was all lower. Services and manufacturing PMIs showed employment component decreasing. There was lesser jobs available as per the JOLTS report. The quits rate also was less. Then we had also the ADP jobs report, private jobs report, which showed lower number. In fact, the private payrolls as per the monthly jobs report was also 1,89,000 versus 2,18,000 that was expected. And we also had the challenger job cuts, and that was one of the highest for for the first quarter of a year for many years. So I think, and at 2,36,000 also, I think NFP is the smallest increase since December 2020. So it's not conclusive according to me, although market has probably was looking at much lower number and it got a number around 2,36,000 in line with the expectations almost. And that's why there has been a markup in the expectations on Fed's move in May to 0.25% increase. And probably the expectation on the rate hike is also driven by what Bullard was saying on Friday. He continued to say that the Fed will fight the economy on two fronts separately. The financial instability will be fought separately, and the monetary tools will be applied to control inflation, and he expects the inflation to remain sticky. He doesn't think that the bank failures will tip the economy into a recession, and he wants the Fed to continue with its macro-prudential policies to address both financial stress and the inflation. So that's the reason Bullard has been one of the better predictors of inflation and Fed policies. And I think market also listened to. But let us also know that the Friday market, in fact, Thursday onwards, the market was very thin. We did not really have much of a reaction, although the yields on the 2-year and 10-year did go up. So we will, I think, now look forward to the CPI number, which comes on Wednesday. Month-on-month core CPI is expected to drop to 0.4% from 0.5%. Whereas the year-on-year core CPI is expected at 5.6% versus 5.5% last month. So I think that may be a better indicator for Fed moves, and also the retail sales number, which will be available later. So I think for once, the NFP has not been conclusive as far as the Fed is concerned. And otherwise, I think there were very little news on the global markets. We did have industrial production in Germany, which was much higher than expected, lower fuel prices, and also the backlog of orders, etc., really helping Germany. Factory orders really jump from 0.2%, 0.1% expected to actually 2%. So Eurozone economy continues to do well, and there were more hawkish statements from Mr. Knott of ECB that Fed ECB will continue to hike rates. So I think we are at a juncture where we are going to again look at what the central banks will do going forward. Definitely Fed as well as the ECB, and that will be setting the direction for the dollar. I think for now, maybe dollar is going to be somewhat rangy between 101 and 103 on the dollar index, perhaps euro also between 10750 and 110. That is what I expect until we get some very strong clues. We also have we had Canadian economy that posted good jobs report on Friday. So again, it's a dilemma for Canadian Central Bank, which had paused last month, and they have a meeting coming up day after tomorrow. So whether they will ignore the job market, which is heating up, possibly market thinks that they will go for one more pause. Now on to India. RBI, with a surprise pause in the rate hike cycle, joined the select band of central banks who have hit the button. Of course, what difference we find between them and the other central banks is that while the central banks like Canada and Australia pointed to a slowing economy for the past, RBI was actually upping the GDP forecast for 23-24. RBI survey even says that credit demand is upbeat. Now, also, while Fed, ECB, Swiss National Bank, and Bank of England kept financial stability separate from inflation fight and continued to hike rate, RBI was citing risks to growth amid the recent global financial turmoil and stopped hiking, even though inflation remained above mandated 6%. This is something that we need to think that probably RBI knows something much more about the inflation and growth going forward, and perhaps that is why they think that we should not go for another hike, or maybe they think that more hikes after a steady hike of more than 2.5% in the last 1 year could impact the economy, although they have not said in so many words. So caveat is that they said that the pause is only for this meeting. But as one would have expected, there was very little reaction from the rupee as far as the RBI decision was concerned. There seems to be a slight bias for stronger rupee after the break of technical level at 82.05, 82.10. So traders tend to sell on rally. But interestingly, at 82.85, we did see PSU banks coming in strongly and buying and pushing it up towards 82.90, 81.95, 81.85 to 81.95. So I think once again, we are down to watching flows and also actions of RBI. More movement was seen on bonds that day because the pause was a surprise. We did see yields moving from 7.28 to 7.18. So going forward, if people are convinced that RBI is done with inflation fighting, we may see more bond buying. But that is something that we need to watch and see whether the market also believes what the RBI believes. Thank you.
Thank you, JK. And just to summarize, of course, there was very little news in the global markets post Thursday due to the Easter holiday period. NFP, as JK mentioned, was not that conclusive. And moreover, there are several reports showing a decline in the available jobs in the US economy. On the upcoming data front, we have got the CPI on Wednesday. This might be a better indicator of the Fed moves. Moving on to the Eurozone economy, it continues to do well as shown by the data of various countries. This, backed by ECB members' hawkish statement, has led to Euro sustaining at higher levels. And on the domestic front, of course, RBI decided to pause their rate hike cycle along with an increase in GDP forecast, which was a little bit surprising. And there was very little reaction from rupee and some slight bias for a stronger rupee due to breakdown of some technical levels. That's it from us today. Join us tomorrow for a webinar on India's BOP and RBI's monetary policy challenges and opportunities. Pankaj Maulik and myself will be covering the same tomorrow at 5 p.m. We'll see you all tomorrow with another round of fresh updates. Thank you so much for listening.